Cash and confidence are likely to drive M&A activity this year. The Chamber of Commerce says that U.S. companies have $2 trillion on their balance sheets. Confidence does appear to have returned or be returning as well. So if you want to know whether there will be a new outbreak of merger madness, no one better to turn to than Gary Parr. He is vice chairman at Lazard. He is one of the best-known merger advisors. Gary, thanks so much for coming in to be with us this morning.
Deirdre.
You talk to pretty much everybody, tons of CEOs. Is confidence really coming back? What are you hearing?
We consistently have, over the last year, seen an increase in confidence because of the markets. Financing markets are coming back. The economy is certainly stable, if indeed in a number of countries strengthening. And that helps to boost confidence. So it is indeed continuing to steadily improve.
We mentioned this almost $2 trillion figure, at least if you look at that Chamber of Commerce report. What are you advising your clients right now? Should they hold on to the cash? Or should they use it to go out and perhaps make a strategic acquisition? What's the best move right now?
Well, of course, generalizations are dangerous, but I'll try to do it in a general way. Cash was an important asset to hold through the financial crisis and even subsequent, because in a sense it was an insurance policy, that if there was a second dip, if there was a second problem, companies would have liquidity. Now that it seems we're through the really difficult issues of a financial crisis, cash is just a dead asset. It's earning nothing. And so that, in the end, is our advice. We'll look at the financial consequences of having a dead asset versus deploying it. Now, a company could instead choose to do a share buyback or increase their dividend or even build a plant. There are alternatives, but certainly mergers are now one of those options.
But it seems like we've gotten over this psychological hurdle where particularly CEOs, maybe in the financial sector as well, one of your numerous specialties, probably did panic and have a sort of hangover after the crisis and want to keep the cash. Maybe now, as you just said, it's perceived as a sort of dead asset. How are banks going to deploy all the cash that they have now, not only just from their own balance sheets, but of course they've gotten a lot of deposits? I mean, there's just a whole different environment than there was even a year ago.
Exactly right. So from the deposit growth, also from the wholesale funding market opening up again, the banks do have liquidity to provide. So the banks, in fact, as you've seen and reported on, Deirdre, they are aggressively lending in the sense that they're making a lot of publicity announcements about their lending activity and indeed trying to push down into the middle market. That's one of the trends. There are two areas that were the weakest in terms of lending. The very large, to support large leverage buyouts, was non-existent a year ago, and the very small middle market commercial was not getting enough liquidity. And we're seeing that begin to open up. The banks are expanding.
Something else that seems to be changing, you and I spoke about this last year, how the U.S. was pretty quiet, and a lot of the mergers that were happening were cross-border deals, and there were a lot between the U.S. and Asia. Do you see that trend continuing, or do you think because the U.S. economy has turned a corner that we're going to see more domestic activity?
Sort of a yes and yes, but in the following sense. Many companies we talk to in industries continue to talk about growth. Where are they going to find growth? And the U.S., even though turning and improving, is still relatively low growth as compared to Asian or Latin American growth prospects. So I'd say there's still a disproportionate, or certainly very heavy, emphasis on growth markets, both in Asia, Latin America.
So most people, when they come to you and maybe they're looking to make a strategic acquisition, they'd rather talk about what's available in Asia and in LATAM.
Exactly. That would be a priority.
What about the risk that we've now seen a little bit more with emerging markets? I mean, there's political instability in the Middle East, but even putting that aside and looking to China, I mean, there's a lot of people who are expecting a bubble, an asset bubble, inflation, and an economy that's growing but not at controlled growth. How much of a risk is that?
It's clearly a risk. The way we try to advise clients, again, in a general matter, is when looking for a growth market, what price do you pay for how much growth? And so you have to make certain set of assumptions about how long will the growth continue, what is the risk that it could be disrupted for some period of time, and you try to price it.
How worried are your clients when they sit down with you and they say, okay, we are interested in this target in China? Do they actually ask the question, you know, have you done modeling on what could happen here?
There is discussion, but I would say there's not a lot of worry. There's more a discussion, again, back to pricing and how to calibrate the right way to go in. But there's a keen interest in, again, investing in and building out in the emerging growth markets.
Gary, we can't have you here without talking to you about what the regulatory environment is doing to U.S. financial services companies. What is this year going to look like?
It's more stabilized than last year. Now we're in the regulation writing phase, and that's a lot of work. The regulators are now interpreting Dodd-Frank. They are now on any number of other steps.
How hard is that? I mean,
really hard. It was over 2,000 pages of documentation that they now have to turn into regulation. So things like defining the Volcker rule are still actually quite open-ended, and even within the last 2 weeks, we've seen investment banks continuing to close down certain aspects of proprietary trading.
Right? Is that what you're saying?
Rather than deal with what the regulation might be, they're still cutting down certain businesses to address what they think the interpretations will be coming out.
So do all hedge funds just end up in Switzerland? All prop accounts just end up there?
Well, certainly it's fair to say a lot of proprietary trading will move to specialty firms. It will move to whether hedge funds or other types of trading platforms. A lot of people actually talk about Singapore as a place to go if one were to pick a geographic place that's an easier place to conduct business of that sort.
Okay, Gary, thanks as always for the time.
Not at all.
Gary Parr joining us here on the Inside Track. He is Vice Chairman and Managing Director at Lazard.